Welcome to your Mortgage Insider Update for August the 19th. Well, it is the week of the Jackson Hole Economic Symposium, where all the fat cats of the world's economic groups, including the Federal Reserve, will be in Jackson Hole, Wyoming. This is the month that they do not have a Federal Reserve meeting. The next meeting will be on September the 18th. So we're looking for clues from Fed Chair Powell on his speech Friday morning for more direction on whether or not there's going to be a cut and how deep the cut could be at the next meeting in September. They're not going to straight out say it, but there's going to be lots of talking heads on TV paying close attention to every word the Fed says. So with that, though, let's take a look at the charts as we start this week off and dive into a little bit about the projection on interest rates as we get into the fall months. As we look at the charts for the beginning of this week, 10-year Treasury is down 1 basis point, staying steady below 3.9%. Mortgage-backed securities are in the positive, and the green is good for higher prices there. And as we look back over the last year, the last time the Fed met at Jackson Hole, they set the stage for what was a huge run-up in interest rates. So just about a year ago, Fed Chairman Powell said the economic impact of these higher interest rates would continue to be painful, and the economy felt the pain with the higher rates into October. So with this year's speech, we want to see, does Fed Chairman Powell set the stage for further declining in interest rates? It's going to come from some of his actions, for sure, not just his words, but we very likely could see tested levels that are now, we are currently just below the lowest point that had been on the 10-year Treasury back in December. Since then, it's been mostly rising for the first 3 to 4 months of the year, and then this last couple months, the decline has been very helpful, but not as much as we want to see as far as bringing the 10-year Treasury down. Right now, I want to go over the spread between the 10-year Treasury and the 30-year fixed-rate mortgage. So oftentimes we follow the 10-year Treasury as a general barometer, and you can see from the prior chart, the 10-year Treasury has gone up and it's gone down. But during that same time, and this is a chart dating back to the year 2000, the average, and this green line here is the 2% spread between a 10-year Treasury note, so today just under 3.9%, a standard 30-year mortgage in the history of, back in the early 2000s. Even it got lower in the 2006 era to 1.6. So let's just say 2% above the 10-year Treasury is 5.9%. Now, one thing we are not seeing currently is 5.9% interest rates, but we are starting to head in that direction. So as this chart lays out, you can see, the spread has been between 1.5%, 1.6% to 2% for the most better part of eras outside of the financial recession in 2008. And then since COVID, there's been a huge short term, there was a huge run up on interest rates. And then while the Federal Reserve was lowering interest rates, the spread between the 10-year Treasury and the 30-year fixed mortgage dropped down to as low as 1.4%. Now, since the Fed has started hiking rates, we've seen the risk to the investors in mortgage-backed securities taking a much higher premium, up to 2.8, peak of 3% above the 10-year Treasury. So this is a constantly moving target, but we have seen that back off, and we are hopeful in the coming year to see the spreads between a 10-year Treasury and a 30-year fixed-rate mortgage to be closer to that 2% number, and that will really help many families unlock their ability to refinance, ability to purchase a home at a more affordable payment, affordable interest rate up front. It could very likely push prices of homes higher still. But in general, so many households have got such low interest rates on their mortgages, but then they have outside debt. They've purchased a travel trailer, they've purchased a side-by-side or a vehicle. Any of those types of loans that you've had over the last couple of years, since maybe you refinanced in 2021 or 2020, those interest rates are much, much higher, and a lot of folks are starting to feel the pinch where they might need to take a look at a new 30-year fixed mortgage. And over the next year to two, we could see these spreads really come back down and help them out. So keep an eye out for the news from Jackson Hole this week, and we'll come back with you in an update first of next week and break it all down. Have a great one.